Good morning, team. It's Gary Mauris at DLC Group Head Office. I am joined today with two very good friends of mine, Robert McLister from RateSpy and John Webster from Scotia Bank. We've just hit broadcast, so we are seeing a lot of you funnel in right now. We're going to start in about 60 seconds. Looking forward to today's call. If you do have any questions, you can send me a quick email to gary@dlc.ca. I do have a lot sort of already in our queue. But the vital ones we'll try and get to. Thanks very much and stand by. All right, team. Well, listen, we're going to jump right in so that we can try to stay as close to the timeline as possible. My first guest today is a dear friend of mine, one of my best pals, Mr. John Webster. A lot of you know John. He's been an industry icon. Was one of the co-founders of Maple Trust, and obviously has been with Scotia Bank at the helm for many, many years. Not only in charge of Scotia Mortgage Authority, but retail lending nationwide. I also have Mr. Rob McLister, and we're going to jump into the second segment with Rob, unless Rob has some questions as we start the journey with John. So, John, first off, good morning and welcome to the call today. We really appreciate you making the time. I know you and I spoke on Saturday night, and you have been around the clock for more than a week. I mean, conference call after conference call with with the BAC, the Bank of Canada. With the insurers, the lenders. Super grateful to have you join us today.
Well, thank you, Gary. Anything for you and Chris, and good morning to those on the West Coast, and good afternoon to those of us who are on the Eastern time zone. Obviously, I had a few thoughts that I'd like to share before we get into some of the questions that hopefully I've anticipated. We were saying before the call began, we really are living in extraordinary times, ones that none of us on this call have ever experienced before. And in a really short time frame, we've witnessed the disruption to the capital and credit markets and an unprecedented shutdown of much of our economy. And for many, many people, a dramatic change to how they work and how they live. So I know it's been challenging for all of you, as it has been for all of my colleagues at Scotia and all of our partners. In the first wave, we were confronted by really volatile financial movements. The market moved in unprecedented fashion. The equity markets dropped more than we'd ever had seen them drop in one single day before. There was incredible uncertainty and fear, and the spread of the pandemic was so exponential that I think it was difficult for most of us to get their head around. But what we didn't anticipate, I think, was the dire economic consequences that had to take place as a result of trying to flatten the curve and the spread of the virus. We all saw in the first instance realtors who contacted us to say they were going to have to stop open houses as they had very nervous sellers. The first issue that we dealt with were appraisers who refused to do full inspections. And we had to move very, very quickly to try to adjust our appraisal policy to accommodate that. And we have, in case those of you aren't aware, adjusted our policy in terms of the numbers of deals that require full appraisals, and that seems to have been well received. We also had to stand up an industry-wide response on payment deferral for mortgage customers. And I think I want to give you a little context on that, because I know that a number of brokers have been asking questions on behalf of their customers. I want to give you some idea of how this works. This was an initiative that had to be developed among all of the lenders, led by the CBA, working with both the FCAC, with Ministry of Finance, with OSFI, and working with my peers across all the other lenders to see how we could come up with a coherent and cohesive payment deferral policy. And obviously the insurers were very key in that. And for the first time in my experience, we were able to get all three insurers to send one communique and get them on the page. And so Gary was referencing most of Saturday and Sunday was spent in telephone conferences with the CBA and the other lenders to set this up. All of the bank call centers were overwhelmed with inquiries. And the problem from the government's point of view with that is that then tied up other folks that are in needs. And it's the same thing with branch closures. We've been pretty fortunate not to have to close that many, only about 3% of our branches. But branches serve a big segment of the vulnerable population that do not access online banking, who aren't as familiar with how to do telephone assisted banking, mobile banking. So it's really important to get those services still available for a very vulnerable group. At the same time, you can appreciate our employees were obviously nervous and had concerns about having to go to work in this environment. So all those things were coming at us pretty fast. But I think that the deferral program was set up and it is working. It's working so well that there's already been over 200,000 applications for deferral across the banks. We have to send in a report to CBA every day that finance has requested about the number of applications for deferral and where the queue is. So we've already stood up a digital site. I think Rob will, I don't know if he's been on it yet. He's usually the first guy that gets on this stuff and the first to report it. So that's really helpful. We set up one as a temporary site and we didn't drive any traffic to it. We have an incredible number of applications to allow for online fulfillment. And we're setting up a more permanent one that goes live tomorrow. So we've been working very hard behind the scenes to deal with that. And the deferral program had a lot of moving parts that you can appreciate because all the banks have different policies. So it's not just the deferral of mortgage payments you have to deal with. You got to deal with property taxes, health crisis, and insurance payments, and all the lenders deal with it a little differently. And in the municipal issue, it's very complicated because the municipalities all have different rules about property tax, and a number of them were waiving the property tax requirement or deferring it rather than waiving it. So there was a lot of complexity in terms of standing that up, but we have the deferral solution. It is working. It's providing relief. And I think it's an example of the most nimble I've ever seen the banking community in that really it's three questions. And if Rob hasn't got on it, I'd be interested in his feedback. And essentially it's three questions and there is no burden of proof, no documentations, and it's appropriate, obviously, in these circumstances. The next thing that hit us were notaries, particularly in Quebec, that were stating that they were refusing to see customers and close deals. And then their government, the midnight before they had declared the provincial emergency, said that they had to, and they had to at least make remote services available. And then you'll all appreciate this, and this isn't COVID-19 related. It was great timing that Finastra decided to have a cybersecurity breach. And of course, it would be just as we were raising rates. So it was, from Gary Morrison's point of view, a perfect storm. And if he had any hair, he told me he would have pulled it out. It was a very, very difficult weekend. So I'm encouraged by, across all of the lenders, the responses to those challenges, because as I talked to Gary about, we're really innovating in real time to meet our customers' needs. And these are circumstances that none of us could have anticipated. We have the lowest interest rates in any period since they've been measured. And there's a lot of talk about the falling bond yields. And then with the Bank of Canada reducing prime and all of the other regulators around the G8 and really across all of the major banks, central banks across the Western world have followed a similar path. And bond yields are important to fixed-term funding, but they only tell part of the story. And so I have to give you a little context. I lived through that crisis in 2008. And in fact, in my previous life, I was a major securitizer at Maple Trust. So I understood how the securitization markets worked and how the capital markets worked, because that's how I got the majority of my funding. So I lived through that financial crisis. So I've had some experience. Now, this is obviously different because it's a health crisis that drove that. But we saw a similar experience. So what happened was, even though the bank lowers prime, what happens is credit spreads blew out. And by that, I mean what the bank pays to raise money in the wholesale market widened by several points. And it was very volatile and continues to be very volatile. And this has a very dramatic impact right across the board. It certainly has an impact on variable, but it impacts across all terms. So notwithstanding that the absolute rate looks like it's declining, our cost of funds, that liquidity premium, that's what we pay to issue instruments, was going up and up. Now, having said that, all the lessons learned in the financial crisis by the Bank of Canada and by the Fed were brought to bear in very short order. And by that, I mean they set up programs, and some of you would have seen these announcements from CMHC regarding the IMPP program. They set up programs for the capital markets to make money available to all lenders, so that over time, there's so much money sloshing around in the system that these credit spreads wouldn't be distorted and would come in, and we'd have greater sort of certainty around rates. But rates are still very volatile. All lenders' rates currently today on a spot basis are underwater. So it's putting incredible pressure on lenders. And so I think this is one of the areas that's very complex, and it's hard to explain to the front line. It's hard to explain to the folks in our branches. It's hard for us to explain to our PRMs. And I know it's hard for you guys to explain to your customers, but that is a fact of the cost of money. The real cost is what it costs to raise that liquidity to fund operations. And I want to give you also an additional perspective. It's really important that people appreciate that as a bank, we have a big capital buffer, and the rules have changed to allow less restrictions on how much capital you can actually deploy. So that's really important when you're trying to raise money to fund mortgages and other products. We also have a big balance sheet. So unlike the monoline, they have no balance sheet. They sell on. They're actually, so you can appreciate this when you're looking at rates and the pressure they're under, like MCAP is a huge client of ours. So all the banks in various ways, whether through their trading desks or through direct purchases, are funding the entire market. And so that pressure is felt right across the system. So it's important when you listen to some of the people on social media and people in the mainstream media talking about rates, that it's a much more complex. And the most important thing in the discussion that I've experienced with consumers, it's not about the absolute rate, it's about certainty. And I think that's what you guys want to hear about. So right now, obviously, in these very difficult times where income verification is challenging and our customers are very nervous about closing their deals, we have to put purchases first, and we have to ask for that income verification where we can get it up front to smooth that out. That doesn't mean that we won't be doing refinances. I've heard that. It's absolutely not true. In fact, in our existing book, for the portfolio insurance that you need to sell into these CMHC programs, they're going to allow us, which they haven't allowed, to use refinances and 30-year AMs for the existing deals. So you will see refinances, but in this very tough time where we're trying to deal with all the impact of social distancing, all the law societies, for example, are very nervous about having to provide signatures. We have the ability to do digital signatures. That's not the issue. The issue is the KYC impact. The Know Your Customer mandate is a regulatory mandate, and there has been no suggestion that there'll be any relief. So that's another issue that we're working on. But we've been working very carefully with all the law societies in each jurisdiction. We've been working with all the title insurers to see if we can stand up a solution on remote closing to allow us to continue to operate the business under these very, very difficult and challenging circumstances. Now, we're very fortunate at SMA and its predecessor business because the majority of that business operated remotely. So this isn't a new experience for SMA. It's a new environment. It's a new economy. It's a new way of behaving. But so far, I tell you that our business has been remarkably resilient. That in fact, if I were to put it this way, to date, the demand for housing in Canada has trumped the virus. And by that, I mean that our book continues to build. Now, I don't think that that is sustainable necessarily going forward, depending on how long it takes to get the numbers of people infected by the virus down and to make sure our health system isn't overwhelmed. But I want to thank everybody for their patience. And I would say that we're all very, very concerned that we put our customers first, our employees first, and that we safeguard our institutions for our shareholders and stakeholders, for all the deposit holders and for everyone who is dependent on financial institutions for their stability. So I'd also like to say, unlike a lot of the people I talk to, I'm very optimistic about the recovery. I think it will be a V recovery. I think whatever you're missing or concerned about in reduction in volumes today, or the difficulty in continuing to source your business, that it will be a V-shaped recovery and there will be a big bounce back. And hopefully that won't be too long. And I think you'll find out whatever business you have to forego today, you'll more than make up by the last quarter of this year.
Awesome, John. Listen, that was a really, really good sort of summary for us. Thank you for that. I think we were on a call the other day with Dr. Sherry Cooper, and I think we're much of the same mindset. One thing this has done for all of us is really, really accelerated the use of technology, and you're getting the different jurisdictions looking at ways to, complete the 360 ecosystem on the actual front to back transaction, and in some cases loosen those requirements. A couple of pointed, maybe direct questions for you, just based on some of the questions that I have been receiving. So deals that are in the pipeline and that have been in the pipeline that are scheduled to close, that between now and closing, so they're already in, they're not new deals, but between now and closing, there is some sort of temporary layoff because of COVID-19. What should we expect from a perspective on how those deals are going to be handled? Are they all case by case? Are the ones that are in the channel, are they going to, we're going to try our best to get those closed regardless of that layoff being short term?
Yeah, that's a great question. So they have to be by nature case by case because not every deal will be a COVID impact, right? And so they're obviously going to be examined. But I would say to you that in those scenarios that where we are leaning towards, and we've just issued, there'll be some new information posted to the broker website, is that yes, if you have a borrower that's approved and then there's a COVID impact, that obviously will be honored. And I think you'll also find on the deferral payment program, if that extends out, you'll see something similar with renewals down the road as well. So I think that all the institutions are mindful, Gary, that this is not the usual scenario where someone loses their job and it's a delinquency and that's going to send in a default. This is a suspension of economic activity, and I think that we have to approach it very differently than we would have approached it in the past. Now, for those of you that had deals in Fort Mac, you would be familiar with what took place there. On a smaller scale, we had the same kind of issues with appraisers because of the smoke and the health threats, and the deferral payment program and skip a payment, and then what took place with deals that were closing, and so this is obviously on a much larger scale. And it's been, I would say, it's like a program like that in a disaster on steroids.
Awesome. Next question for you, John, is you talked about you've been very fortunate with branch closings, and somewhere around 3% of branches have been closed at this point. So going forward, I mean, Scotia obviously has the in-branch closing program. What do you see, and where are the concerns around there? Are you expecting more branch closings? And if there is mandated branch closings, which I guess maybe there's not because you're considered an essential service, what do you think we should be thinking about, if that's even a possibility?
Well, all of our deals are solicitor closed, right? What you're really talking about is where the personal credit agreement gets signed. So right. I think that we've already realistically had a determination that it's not reasonable to ask a customer to come in these circumstances if they don't want to put their health at risk, right? It's hard enough to deal with the anxiety of employees. So what we're trying to do and figure our way forward is do exactly what you suggested. Every day we're trying to innovate with our own folks in the digital factory, but I'm on the phone to the title insurers and to the insurers and to anybody else, including my peers, about what steps they're taking. So I think what you said about creating that sort of digital universe with an assistant is the direction people are definitely going in. Everything that we can do remotely, we will do.
Yeah, awesome. It's going to be, obviously, as we said, I mean, so many of us getting so much better. I mean, we sort of deployed 150 head office staff at home with, virtually little interruption. So I think this is going to be, a blessing in many ways for us. Rob, I know you had a couple questions you wanted to ask John. I have several more, of course, but let me just turn it over to you. And, you have always been cutting edge, Robert, and you and I have been dear friends for a very, very, very long time. And, you seem to be very, quick, as John pointed out. So let me hand it over to you for a minute.
Yeah, thanks, Gary. And I appreciate you guys having me on. And hello, Brokerland. Hope you're all doing well. John, a couple quick things. So at RateSpy, we track the entire market, and I'm seeing a significant, obviously significant increase in variable rates or reduction in spreads from prime rate. And it's materially, the rates are going up in variable more than they're going up in fixed. Could you explain that, like why that's happening?
So Rob, like the most popular instrument, and this might be of no interest to the people on the call, for banks, et cetera, is a banker's acceptance, right? And then they had to open up the till at the Bank of Canada to get that funding and that flow. And when they brought in short-term measures, spreads were still blowing out. So the problem is the shape of the yield curve, right? So the problem with short-term money was not, it wasn't the usual slope that people expected with all of the money that was released into the system. So short-term funding is still very, very expensive. And one of the things that happens for lenders, because for us, we obviously have retail deposits and wholesale funding. So you can appreciate that the deposit activity also changes when you have a crisis like this. So that is problematic. And you have to sort of watch it. Like, people need cash. People want to early convert their GICs. All that kind of stuff goes on. And then the money market instruments, they've increased all the things that you're allowed to put up for collateral to get money. So I think, Rob, that it should, the distortion should correct over time. But it's been very, very volatile. It was like this during the financial crisis too, for when the credit markets seized up. But there's more liquidity in the system. It's like they decided whatever ammunition they had, fire it all at once, instead of like they did in 2008 into 2009, fire around, wait, fire around. They just let everything out. And so there's a ton of money in the system. So I think that that stuff will happen. But the fixed term funding is a little easier to do right now because we're able to issue covered bonds. Those are bonds that we sell as an institution that are supported by mortgages without the portfolio insurance. So we're able to sell those into different jurisdictions, and that's usually used for fixed term funding. So that's why you haven't seen the same kind of spread deterioration, even though if you looked at a deposit and did that, or a bond yield across what mortgages are charging, you'd see most of the competitive rates would be underwater, and that's before you pay for the brokers or pay for BRMs or pay for anything else. So it's very challenging, and I think it will sort itself out.
Yeah, it makes total sense. Thank you. So the prime BA spread is compressed significantly. So is that a big reason why we're seeing this reduction in variable rate discounts?
Yes, it is. But what happens in this thing is the first thing that goes are corporate bonds, right? Anything that's considered with the higher risk. And those spreads blew out, and it just cascades on down. And so even for RBC and TD and ourselves, what we're able to borrow money at was, overnight went up 2 or 3 points. And now it's started to settle, but it hasn't settled in the short end. So it's, as you identified, it's very challenging. And when I talk to our treasury and our guys who work the desk, they're saying they've never seen anything like this in their life, like even the ones that obviously went through the last crisis. So a lot of the volatility on the markets is driven by all of the automated trading programs, right? That those algorithms, 70% of that market's driven off passive investors that are driven by a mathematical formula. So it's not quite the same circumstances that we experienced before. And in terms of what will happen over time, they have basically today, CMHC announced that they're going to add another $100 billion into their IMPP program. And that's the program that you can create CMB and then sell it back to them, and they give you funds, and all the monolines have access to it. Anyone who issues that stuff does. So that'll provide term relief, but it won't help the variable.
So guys, I'm going to ask a question to both of you because I want to be really, I want to make this call to be very, very helpful for, for the average broker dealing with their customers right now. So if you were dealing with a customer today and they were saying, okay, based on what's going on, volatility and what's going on with the COVID-19 and the effects, which way would you instruct your clients to go now when it comes in terms of product? Robert, you want to go first?
Well, I'll let Rob go because he's always publishing his advice on this.
Right. That's why I'm picking Rob first.
Hopefully I remember it. So, just as recently as a few weeks ago, variable rates were looking tremendous for new borrowers who are very well qualified. And obviously, term selection is very personal. And it depends on your 5-year plan, your qualifications, your financial safety net, all that good stuff. So, but for a typical well-qualified borrower, we were seeing prime minus $1.20 in some cases. Now, if you get prime minus 25 cents, I mean, you're doing really well.
You won't get that today. That'll go away too, unless things move. Like prime flat is underwater. So that's the problem with that. That's why you saw all those prime discounted move up.
Yeah. Yeah. And then so at RateSpy, we track all the lenders. So there's still a few laggards out there who are offering good deals. But, further to kind of the gist of the message here, the optimal term has changed. Even in a couple weeks. So now we're looking at, if you look at the nation's lowest widely available conventional rate for a 5-year fixed, it's through Canada Life at 2.49%. You compare that to the lowest conventional widely available variable rate through Mauris Bank, and that variable rate is 10 basis points higher. And so, if you're trying to figure out where things are going, and I caution anyone about making rate predictions, but if you try to model this out, and we did so on our site today.
So, hey, Robert.
Area. Yeah.
I always coach, and I always ask our professionals to try to be as educational and decisive as possible. So try to give us, for a well-qualified boy or borrower, a decisive sort of opinion.
Yeah. So if you try to model this out and you use kind of the 2008 experience as an analog, then let's say that we cut another 50 basis points, the Bank of Canada, and we go down to a 1/4 point. and things, linger around there for a year and a half or so. And then, the Bank of Canada slowly starts increasing its rate, and then we plateau for a while. Because this could be, and we haven't talked about this yet, but, while we could very well have a V-shaped recovery, as John said, there's going to be some people that are out of jobs, and they continue to be out of jobs. So if you kind of model it out and you compare the starting rates today over a 5-year span, you could make a case now all of a sudden for a 5-year fixed. So it really depends on, your starting rate, obviously your risk tolerance, your plan, your potential need to break the mortgage, because penalties are a major factor. So what I'm saying is that as of this minute, because things change, if you can get a really, really good deal on a medium or longer term fixed rate, that's not a bad option.
So let me respond by, Gary, let me respond by saying this, twofold. One, Canada Life, I don't know about the 3 mortgages they do, but in the broker space, but let me tell you that every life company and every pension company is in dramatically different circumstances today than they were 3 weeks ago. Most of them depend on their capital is all invested with money that they get from the premiums into securities. And so they've all taken a huge hit. A lot of pension funds that were making double-digit returns now have unfunded liability. Life cos are no different. So let's talk about things that matter, material players in the space. I tell brokers, and this has nothing to do with this permanent crisis, but it reinforces that the best thing you can do for your customer is certainty. And what you want to do is remove their fears and anxiety about getting the deal done. I think the consumer is incredibly well served by rates today. I've never seen anything like it. And the reality is that no one can predict this out, any rate hub, any model, because this isn't like 2008. This is completely different. The economic consequences are because of a spread of a pandemic that nobody can predict. Even with everyone in Beijing going back out and partying, going to restaurants and out in the streets, they don't know what will happen with the second wave of the virus. Right. So that's why this is impossible to model, because no one's ever experienced it before. It really is like a wartime footing where we're having a war with a virus, and the economic and financial consequences are as a result of that. So I would say that you want to give the customer as much certainty as possible. And at these absolute levels, the issue is not around the interest rate integer.
Right.
Yeah, and I would add to that, obviously these are very unprecedented times. And it's unprecedented in the amount of government support and liquidity that's being thrown into the system. So that will have an impact on our economic recovery. And, you could make an argument that once we get through the next few very difficult months, that the recovery would be much more optimistic than what we were facing in 2008, when we had a fraction of the government assistance and stimulus that we do today.
Yeah, John.
Well, even that $2 trillion in the U.S. is unprecedented, right? If you adjust it for modern day dollars for what they did in the Depression and any other recession, it's a factor of 5 or 6 times greater. So that's an incredible amount of money to stimulate the economy. You're absolutely right, Rob. And the same thing is taking place in Canada. So if it doesn't last that long, I think that obviously the bounce back will be quicker. If it lasts longer, I still believe there'll be so much pent-up demand, and the labor force will re-engage, and we will see a big recovery. And I think housing demand is so strong that it will be one of the first to continue to bounce back up.
Yeah, so one of the things that I'm hearing from both of you in one way or another is obviously at this time when there's much angst and anxiety out there, the most important thing we can deliver to the consumer is clear guidance and advice and that certainty that John spoke of. So that certainty, there's probably a very, very strong argument, that now when you're looking at, the options in mortgage, that fixed is a very viable alternative. So that's what I'm hearing, guys.
Yeah, depending on the borrower, absolutely.
Of course. Yeah, absolutely.
So, I mean, you just one quick last point on that. I mean, like John said, this is impossible to predict and impossible to model, but we have to try at a very minimum to, map out the worst case and best case, and then, figure out a base case. And that's what economists do every day. So we can look back in history, we can kind of try to make an educated guess. Here's what we know, though. We know that the neutral rate of interest is falling. I think when the Bank of Canada announces its neutral rate next month, I think we'll see it ratchet down again. And I don't think anything is going to change that. And this, crisis sure as hell isn't going to take the neutral rate higher. So, it really depends on the starting rates, like I said, and the client's 5-year plan and risk tolerance.
Yeah. Hey, John, do me a favor on Saturday. Sorry, go ahead, John. Comment on that.
So I was going to say, out of respect for bank economists, because I know you have one, our bank economist he was at the Bank of Canada in the last crisis, and he still doesn't believe me when I tell him that our pipeline has gone up.
Well, it's interesting. So that actually leads me to my next question, John. So can you tell us, just out of interest, we saw some numbers out of the U.S. today that new business applications are off 30-something%. So when we look at what you're seeing at Scotiabank, which is going to be reflective of the big six probably, what are you seeing? Are you seeing new business off 25, 30, 40%? And are you seeing refi is up, and HELOCs are up by how much?
So I would say the mortgage business, separate that from the bank business. We have a very big auto business in Canada, and now we have no business because all the auto dealerships are shut down, right? There's no other way to go. So you have a lot of businesses, corporate, commercial, all that stuff. Those numbers change dramatically overnight. In our business, Gary, I would say that HELOC was the delta between the mortgage rates and the HELOC, because it is a prime-based product, and it wasn't so heavily discounted as variable was. Wasn't attractive to borrowers. I'm not so sure that it's about the gap in rates anymore. Most people looking for HELOC are looking to get some cash to give them some security and fund, how they're going to live in the next few weeks or months. So, but we haven't observed a very big spike in that. There's been some pickup, but I would call it modest. So to answer your question, and in terms of mortgage appetite, it's not what it would have been in a typical spring market, if we could ever say there's a typical spring market anymore, but it's still ticking over. Now, the question is, as this becomes more difficult and as consumers adjust to this new how we live and work, that's, most people believe in the industry that that's bound to continue to tick down. But it's been so far, like 30 days out, very, very steady and very, very solid. It's just a matter of marshaling our resources, making sure that everybody works together. So, we deal with the highest priority issues first, which are making sure that people get their purchases closed and don't start to create a bunch of domino effects. Make sure that people are able to defer their payments that have lost their livelihood temporarily, and then try to deal with everything else.
Yeah, one of the things I'd say to everyone on the call here, and you can certainly help Scotiabank and all of our other partners out there. If you're speaking to your clients and they're asking you about deferrals, please make sure that you explain to them that the banks on average are getting 5,000 inbound telephone calls a day and thousands of emails, from people asking about deferrals. And if you haven't suffered an outage or a work loss, or you haven't been laid off at this point, please don't just call to look at your options at this point. Give that a few weeks if you want to make those calls, because what you're actually doing is clogging the system right now, and you're making it very,
the inbound
very
calls are, Gary, it's way worse. The inbound calls are like 20,000 a day now.
They're that much now. Unbelievable.
Yeah.
Unbelievable. So, guys, we have to be frontline forces. We have tremendous partners in our business, and, please make certain and spread that word that, if you don't have a work stoppage at this point and you haven't been laid off, please do not send an email or a telephone call into these lenders, because you are hurting those who absolutely need this. John, the other thing I want to just talk about, on Saturday night, you and I spoke for whatever it was, 90 minutes or something. And you had said something to me that was very, very interesting. And you know, and I'll sort of set it up by this. I'm not necessarily a Trudeau fan, but I have to give kudos and accolades to the Ministry of Finance and to Trudeau for how they've responded to this crisis. And one of the things that you said to me is that they've made it very, very clear to, you know, all stakeholders and all partners on these calls that you've been on, you know, that this is not the time where, you know, they're looking for, you know, any partner to be opportunistic, to gouged. I mean, they are putting immense pressure on the financial service sector to make certain that they are playing fair ball and are being very helpful. Anything you want to comment on that? I found that quite interesting.
Yeah, I think that you're absolutely right. I've never seen regulators be this flexible in my lifetime, and cooperative, and they. I think that the government does get it, that they really knew that they didn't know how big this was or the implications of what they were dealing with, and so they have behaved in a way towards the financial sector in a way that I had not experienced before. So I think there's two parts to that. One, they want financial institutions like ourselves to be good partners and custodians, but good citizens. And they expect us to do the right thing by the public. And that's certainly the steps that we're taking in every process that we develop to respond to these very changing customer needs, is to make sure that this is the right thing to do for the public and for the country. And so it is much more like a kind of a wartime ethos and response than you would experience when there's just a straight financial crisis, because it is a pandemic. I think the interesting thing as well, I mean, I could send you some stuff Hurley sent me, David Hurley from Gandalf, a summary of all the data that was done. And I think that leaders who behave that way, as Trudeau has, in a complete stark contrast to Trump, who has been completely exposed in being petty and non-presidential in a time of great crisis. It's uneven in terms of political support because it depends where you are. No one in Alberta is saying that Trudeau's done a good job, right? Because they've really, I mean, it's so devastating to understand 2 oil shocks and then to have the pandemic on top of that. So I completely sympathize with that, and then to have a war in terms of production of oil between the Saudis, the Russians, and the Americans. So poor Alberta is really, really in difficult straits, and I completely empathize. I think it's interesting for organizations that they really now are going to refocus and truly value their human capital, because I've been absolutely pleased by the response of our folks at work, the way that the ones that we still have funders and mortgage accounting clerks that have to go into the office, ride the public transit, deal with all those issues, and they're still doing it, and they're doing it, and they're performing at a very high level. And the same thing with all the other aspects and stakeholders across the bank that we deal with, whether I'm dealing with legal or compliance or audit, or the service groups, the people that do the back end, the people that aren't customer facing. They really rallied. And I think that you'll see large organizations put a different emphasis on human capital, because previously, you know, people said disaster recovery was all about what your physical setup, what business continuity, what backup servers you had. But now they're realizing that the people, you have to put people first. So hopefully that's a positive change, I think. And you see that across retailers that are bonusing people up, that are having to be in harm's way to continue to provide services that we all need. So I think that'll be a change for the better. And I'd say to brokers, you know, be kind to your lender and be kind to each other, because these are incredibly difficult circumstances for most people. People are pretty stressed out, and everybody's trying to do the right thing, but it's all happening very, very quickly. So as Gary said, like, prioritize your needs and be patient.
Hey, Gary, one quick point on what you mentioned in terms of what the government's doing. So it's very interesting to consider for a minute, you know, the level of stimulus that we're getting and the level of assistance we're getting in the funding markets. We've never seen anything even remotely. This is magnitudes order of size greater than anything we've ever seen. And yet, you still see the credit spreads fairly wide. You look at what your typical Big Six bank is borrowing at for 5 years in the bond market, and that spread is still near the cycle extremes versus what the government's borrowing at. So we're definitely not out of the woods by any stretch. And John, this is a question for you. If credit spreads theoretically were to stay where they are today, do you see fixed and variable rates still deteriorating further from here?
Oh yeah, they'll continue to go up if that doesn't correct. But Rob, I really believe that part of the problem with the capital markets and the way they're behaving is if you look at the news in New York and you see that people wearing garbage bags as frontline hospital staff or refrigerated trucks as temporary morgues, that all impacts the psychology of it, and it's the unknown. So there is, as you said, so much money in the system that if we can see where the end of the curve is coming, I think you'll see all those credit spreads come back in. And they were 2 days ago, they came back in a bit, and then yesterday they popped out again when they heard that the United States and New York in particular was the epicenter of the virus. So, I mean, a lot of that activity, as you know, is focused around New York, Toronto, London, and so whatever happens in that local media market, in my view, really does influence what happens in those capital market activities.
So, guys, a couple quick last things. I just so everyone on this call knows, there is a follow-up call right after this call with Naz to talk about what's going on in the appraisal industry right now. If you look in your inbox, you're going to see a link. So when this call ends at 11 o'clock, you can jump on there. I'm going to spend about another 6 or 8 minutes with Rob and John, and then I am going to, because this was a level up call, I'm going to sort of leave you with 4 or 5 ideas of what I think you can be doing in the crisis. Before we jump into that, so based on what's going on right now, I'd like both of your opinions on your thoughts around coming through this. Obviously, you've heard us say on the call the other day with Dr. Sherry Cooper, and you've heard John say it today, this is a health crisis, not a financial crisis. So it is remarkably different than 2008 and 2009. But John and Rob, coming out of here, do you guys think that we are destined for a recession, or do you think that we will power through this and see that V curve that we are speaking of?
Well, I think that if you look at most economist reports these days, we're already in recession. Goldman's talking about, a potential 18% drop in GDP in Q2. You have obviously a lot of people out of work temporarily, but there's going to be a material minority percentage of those folks who don't go back to work in the near term. These are people that are going to have to find another job because there's going to be some economic damage done. And now we're not talking a majority effect. We're talking about a meaningful minority, but nonetheless, whether it's, and this is not even to speak of the fact that this virus might come back for a return engagement, and if you have that worrying people about, going to the movies, going to the mall, going on a cruise, going out to eat, this is all going to have a lingering economic impact. I don't know for how long. No one does, but you have to look at it from that lens, I think.
John?
So, we're in a recession now. We were at, 1.5%, less than 2% GDP growth. And now we went the first, like last week, it was -10. And I think that Goldman's right, they say it might hit as low as -20. We're probably about -12 right now in terms of negative growth. But having said that, the amount of money the U.S. just approved yesterday is like 20% of the GDP. So it's an incredible number, a couple of $1 trillion. So I think, Gary, there'll be so much pent-up demand. I think that Rob's right. I mean, people will want to know that there's a vaccine that's been developed, or that if you did acquire the virus, you've developed some immunity. But for a lot of people reading early stuff, they don't know that many people that have been impacted, so it still isn't really real for them, other than this surreal economic environment that they are now living and for those that are still working in, and for a lot who aren't working. So I think there'll be so much pent-up demand that people will want to go to sporting events. They will want to go to restaurants. They will want to get out there and experience life again. And so they'll be spending. I'm not suggesting people are going to jump on cruise ships anytime soon, but I do think people will travel again, and the airlines will have a pretty strong comeback. Now they're getting all this subsidy anyways in the U.S. I mean, the hotel and airline industry, the travel industry, I think will bounce back because people's memories are short, right?
Absolutely.
Like I remember SARS was very concentrated in Toronto, not very much so in the rest of Canada, and it hurts Toronto in terms of the tourism business for live theater, hotels, and restaurants. And, it did take some time because Rob's right. People will be nervous about going to these things. But I think because this virus really impacts those that have either an underlying condition or older populations, I mean, the issue around Italy and what happened is really a failure and a crisis in their healthcare system. I mean, if we had enough ventilators and enough ICU beds and enough gowns and enough masks, I don't think we'd be having the same conversation today. So that's what they're really trying to avoid. So I think economically, the underpinnings, the U.S. economy was still very strong, and our economy was creating record levels of jobs. And in fact, most employers couldn't fill that demand. And I think you'll see a lot of employers have been reluctant to lay off on that basis because if the recovery is sooner, they want to make sure that they have enough people to fulfill those functions. So I remain very optimistic about the recovery. I think you'll see a big surge. I know you, Gary, and I will do our best to spend our way into the recovery.
We're gonna definitely make our contribution. Okay, guys. So just a couple of things. You can stick on if you like. Just why sort of finish with a few sort of things for our brokers, what they can be doing during the crisis while they're working at home. But before I do that, John, I want to thank you very, very much. Your insight and your knowledge about our industry is incredible, and we're so grateful.
Well, my pleasure.
Yeah, and Robert, same thing. As I said, you and I have been a dear friend for a long time, and I really admire, your perspective as well. Robert, I'll probably get you on another call sometime next week if possible, because I had a whole bunch of other stuff that I wanted to speak to you about. Johnny, I know you're incredibly busy, and we're just happy to have you make almost an hour for us today. Really, really quickly, guys. So we have about 7 minutes. So this is actually part of our Level Up series. So I sort of just made a few notes on what I think that you can be doing during the crisis and how to respond during the crisis, and what you can be doing at home. So number one, you've heard me talk about this. Everything is slowed down right now. People are at home. There's no retail spending. There's never, ever been a better time to absolutely, truly connect and build social equity. So you need to look at your database and start from the oldest to the newest, and you need to call every single past customer. And I mean truly connect. I don't mean an email, or I don't mean a text. And you're just going to check in. You're going to ask if they need any guidance. Are they familiar with the mortgage deferral program? It just shows that you care. And, if they need any links for any of the, deferral programs, if they need lender contact information. So I can't tell you how important that is. I mean, everything we do, should be about relationships and not transactional. But not only that, but there's never been a better time as you actually go through and make these phone calls to just say to your customers, listen, I just want to make sure my database is up to date. And do I still have the correct email and correct street address and correct, phone numbers for you? So make this time count. Okay. I want you to make sure that you're calling every single customer and just checking in. And I can't drive that point home enough. I've received so many nice messages and phone calls in the last week or two. We've been telling you to do this for a long time, and now a lot of us have time to do that. The other thing I want you to do is market. When I say market right now, the best way to market is just to educate via social media. And if you're on this phone call right now, and if you haven't mastered 3 social medias, LinkedIn, Instagram, and Facebook, just start with those 3. Now is the time. There is some of you on this call that say, I don't use it very much, and I'm not familiar with it. You can't teach old dogs new tricks. It is so easy to use. It is point and click. There's tutorials online. We are running training programs all the time. I mean, you have to make sure that you are reaching out. And I don't mean just liking somebody's comments. you know, you get to look at all of your past customers and friend them and invite them on your social media platforms. You can monitor their social media feeds. You need to go out there and share some clips and share some of these educational, you know, things that we're covering right now online. And you need to learn that. One thing you have to keep in mind right now, as John said, and as, you know, he heard from the federal government, you have to market with sensitivity right now. Anyone appearing opportunistic, that is taking advantage of a situation that maybe is increasing their prices, this is going to be remembered, and it's not going to be remembered, you know, positively if that's the way you are doing. So I don't want you going out there lowest rate and take advantage of the COVID crisis and all that sort of stuff. I want you to go out there and I want you to market and I want you to post about guidance and advice and sharing knowledge and links. And, you know, it's a really great way to reach thousands of people right now, just checking in. But you need to be using social media. And if you're not on it, you need to be on it. Third thing you can be doing right now is carve out time to solve problems in your business. If there's an area in your business that you're struggling at, there's an area that maybe is a cash drain, maybe it's underperforming or undermanaged. It's a part of your business that you can identify as being clunky or disruptive, or it's very time consuming without getting, you know, a satisfactory return. Grab, you know, your staff, your lieutenants, anyone who can help you out, and actually make time to think, right? To actually just solve these problems. We often put up with problems and say, I got to get to it for an extended period of time because we don't, you know, make the time to actually think through and solve. You should have more time. I mean, I've been home now for 12 or 13 days, and it is amazing how much more I'm getting done. I come into my office in the morning and I am powering through things because we are just, you know, uninterrupted. So I want to make sure that you use that to think through the problems in your area, identify them, and make time to actually, you know, try and solve them. Obviously, use this time not only to reach out and guide your past customers, but, you know, any referral source that you had, any, you know, someone who's, you know, helped you in your business. It could be an underwriter, it could be your top favorite, you know, BDM. Reach out to them as well, guys, and build those relationships. Check in with them. You know, for those of you that are working for, you know, are working with realtors business largely, you know, in the next month, we think is going to continue to slow down, especially on, you know, new home purchases because of open houses and house sales. Maybe check in with them and see if they need a mortgage deferral, or see if you can help them, you know, set up some emergency funding. We forget about them often, but yet there are, you know, very valuable referral sources. So, I mean, you know, think differently, right? You know, think the way nobody else is, and make that effort. Stay in touch with every mortgage client that you have in the queue right now. If you have a mortgage application in and it's scheduled to close, it isn't enough to check in once every single day. Hey, I'm here. Everything's great. Here's an update. I'm getting information. Your customers are absolutely terrified right now. Last two things I'd sort of leave you with is be decisive. I know we've talked about, you know, sort of how to communicate with clients. Nobody likes a fence sitter. Education is really, really important, right? If you're going to be a leader in this industry, you need to be decisive and you need to give clear instructions, you know, based on the information and education that you have. So make sure when you're reaching out, you're giving clear advice. All right, guys, we have 1 minute left. There is a call right now with NAS. If this call was helpful, please go on social media. Please tag Rob McLister. Please tag, you know, John. Talk about, you know, the contribution these two made, and talk about, you know, what we're doing as a company to help educate all of you. It's about building a village right now and supporting each other and getting more people dialed in so they, you know, attend these calls more frequently. It's so important for us to be leaders in the Canadian sport, in the Canadian finance sector right now, to be the CNN of all things, you know, that are impacting Canadians during this very, very, you know, nervous time as we go through the COVID-19. So tag me, tag Rob, you know, tag John, make a comment about the great comments from these two gentlemen. I'll be looking for those, and I really appreciate it. As always, guys, I'm an easy guy to get a hold of, Gary@dlc.ca. If you need me for anything, please send me a message or call me directly. Gentlemen, I can't tell you how grateful and how appreciative I am of your time today. Thank you very, very much.
Well, thank you, Gary. And I want to say to all of you brokers, thank you for your business and your support.
Appreciate
Yeah,
it,
thank you
John.
very much for having me, Gary, and to all you brokers out there doing an amazing job at keeping people informed. Keep up the amazing work.
All right. Thank you, gentlemen. We'll talk soon.